Well, welcome to today's webinar, everyone. Appreciate you guys joining. I'm super honored and excited to be a part of this esteemed group of industry professionals here to talk about such a relevant topic in the industry. As you likely know, build-to-rent properties have been around for quite a while, but picking up great momentum in the last couple of years as inventory is constrained and investors are starting to partner with builders to build some of these properties and communities in targeted areas. So today, one of the goals today is to go over a brief overview of single-family residential properties as well as build for rent, just to understand kind of some of the key differences there and dive into some of those specifics. We actually have 3 juicy portfolios to delve into and give investors some key takeaways on how to evaluate some of those differences and thinking through the impacts to servicing and financing, title impacts, and some of the other considerations that might impact returns. So before we jump into it, I'll go ahead and introduce myself, and then I'll turn it over to our impressive panel here to introduce themselves, and then we'll jump in. So my name is Sean Shanuda. I'm the Chief Operating Officer for SES Risk Solutions. We're a 35-year-old insurance company specializing in providing insurance solutions for real estate investors, property managers, and financial institutions. We do so through a proprietary self-service enabled policy administration tool that has integration capabilities and makes it really easy to service the insurance needs for our clients. We've actually had the great fortune to partner with many of the panelists here, so excited to turn it over to them. But when we start thinking about all the different aspects here, we really have the full gamut. So I'm excited to introduce you to these groups. So Olivia, I'll go ahead and start with you if you don't mind.
Yeah, good morning, everyone. I'm Louie Ferguson. I'm the Vice President of Term Lending here at CoreVest. At CoreVest, we're a nationwide lender really geared towards the residential investor. And we're really a true life cycle lender in that we have, multiple products, including construction, bridge, and long-term financing. And specifically on, the build to rent side, over the last 7 years or so, we've financed roughly 10,000 units, equaling around $1.5 billion in loans. So I'm excited to be here today and provide some insight from a lending perspective.
Thanks, Lee. Lee, why don't we go to you next?
Sure. Thanks, Sean. I appreciate it. I'm Lee Rogers. I'm president of RealProtect. We are a national insurance broker that works exclusively with real estate investors. We insure over $7 billion in residential assets across all 50 states. We, like everybody else, have noticed a trend over the last several years of more and more build for rent. And not only do we provide insurance for the hard assets, we also provide insurance and risk management services for the life cycle of a development, right? So as folks are buying properties, are buying developed lots, buying raw land, there's a lot of risk management and insurance considerations that come along with getting into that silo of the business. And we're excited to see this continue to progress and provide risk management and insurance for those folks who are venturing out into this sector of the market.
Thanks, Lee. And Peggy.
Hello, everybody. My name is Peggy Dalton. I'm with Stewart Centralized Title Services. And my area of responsibility with the teams, I have 2 groups, Investor Solutions, which is encompasses all of the SFR and build to rent communities. We do bulk transactions. We do single placement transactions, securitizations within that group, anything that falls within the investor space, which includes refinances as well as purchases. And then the second group I have is default title services. So it definitely complements the opportunities for national purchases as well. Thank you.
Thank you. And Michael, why don't you go next?
Sure thing. Thanks, everybody, for joining. Michael Finch here. I'm a principal founder of our SFRhub companies. We operate in a few different capacities, one on the commercial brokerage side on a national level, and we are 100% focused on representing buyers and sellers in the single family and build for rent investment space. We also have a company called SFRhub.com. That's a data research evaluation technology platform that enables us to help buyers and sellers in the space, and we have our third company, which is SVN SFR Capital Management, which is a asset management and operating company investing in the build for rent space. And across those companies, we've had the pleasure of working with everybody here on the panel and have either, whether that's through title, lending, insurance, and property management. So excited to be here and looking forward to the conversation.
Thank you, Michael. And Randall.
Hey, what's up, guys? Man, talk about a mastermind. This is like what it looks like, being associated and affiliated with all the key pieces of what it takes to find, to acquire, to then put all the best practices in place on a build for rent situation. I'm super excited to look at these portfolios together. And I kind of feel like, Sean, I'm glad you saved me for last, because I'm either the redheaded stepchild of the group or I'm the operational dirty little secret. I don't know which I am, but I'm the property management representation. Hi, guys. I'm the vice president at Property Management, Inc. We have over 400 offices. We manage scatter site, multifamily, all kinds of different assets. We have about 100,000 properties under management right now, and that includes HOA expertise as well as single family and build for rent. So yeah, single source solution for investors looking for property management. That's who we are.
Thank you guys so much. As you can tell, you're right on, Randall, with the mastermind here. It's definitely a fantastic group. Proud to be a part of it again. And Michael, if you don't mind, can you just kind of jump into a little bit more to frame up, what build for rent is and how that might differ a little bit from some of the single family residential portfolios?
Yeah. I mean, build for rent has really come on strong post-COVID, and it was, a growing asset class. Realistically, starting in probably 2013 or so, but I mean, that's probably pushing it. There was only a couple groups in the country that were even doing it. But build for rent really kind of came on strong, I would say, in 2017, 2018, when a lot of the existing SFR operators were recognizing that a lot of the portfolios they've aggregated over the last 10, 12, 15 years, which was a lot of older vintage homes, had, more significant CapEx and repair and maintenance items affiliated with them. So they started focusing on newer homes. And with the limited supply and increasing demand that's just been occurring year over year, build for rent has really, come on strong for a number of different reasons, whether it's lifestyle choice or lack of interest in the cost of ownership anymore, more flexibility. There's probably 40 key factors as why people are choosing to rent or renting out of necessity, especially given where home prices are going today. And within build for rent, there's subcategories within the asset class as well, because build for rent can be, a whole community or subdivision of detached single family homes, typical 3, 4, or 5 bedroom homes. It can be a subdivision of attached product, like townhomes. We've seen a lot of duplex product throughout the South and Southeast. And then you have the horizontal apartment style build for rent, which is very popular here in Phoenix, and some of the groups that started doing that here have been moving into Texas and Florida as well. And that's, when I say apartment style, what I mean is that they've been building detached, 1 bedroom, 2 bedroom, and a mix of some smaller 3 bedrooms, rarely going over 1,200 square feet on the 3. But, really squeezing in the density, but still having detached units, but they're all typically on one parcel of land, no different than an apartment community is on one parcel of land. Apartments just tend to be stacked. The horizontal regime concept is filling a unique niche for the type of tenants that don't want to live above, below, and in between other tenants. So the build for rent, asset class is and there's even, I'm sorry, I missed one, which is the scattered home build for rent, which we see a lot in the South and Southeast, more typically where there's excess lots, and builders are building new construction homes, and investors are buying them and leasing them, creating a scattered home portfolio, but still new construction homes. And then we also see that in portions of communities as well, where maybe a public or regional builder is building out a 250 home subdivision, but they're willing to sell 5, 10, or 15% of their product scattered around that community to an investor that will then lease the homes and be amongst a number of typical homeowners. So a lot of different ways to look at it. They all work. They're all filling a need, and it's really diversified from the more vintage scattered home portfolios that are still widely popular and doing well. But it's just a new look, and a little bit easier from an operating standpoint, given that there's no CapEx, no repair and maintenance for a number of years to come, and you get a base of affluent tenants that are largely choosing to rent, and have a real pride of ownership in moving into a new home, and they're essentially part of the community. Their kids go to those schools, same as the homeowners in the area. So yeah, just been a great asset class, and it's just been growing by leaps and bounds over the last 5 years. I think the recent stat was there's about 85 billion of capital that has come into the build for rent space. It's a little misleading in that only about 17 billion of that capital has actually been deployed to date. So that's about 20%, which equates to about 54,000 homes. But we're anticipating seeing 70 to 100,000 homes for build for rent being built, year over year the next few years, and that could even increase with the slowdown of retail sales as interest rates are rising, and we'll see how that affects the market. But all signs point to positive directions, I think, for rental operators, whether they're buying vintage homes or new construction build for rent homes in whatever that capacity is.
Thank you for the overview. I appreciate you sharing some of those stats. I mean, like you said, a quarter of the capital being deployed compared to, the 17, 18 million single family residential rental dwellings that are out there in the United States. You talked about some of the different types of portfolios for build for rent or communities that can be built, whether they're standalone or detached or attached type of thing. Is there a common formula for a specific geographic or targeted demographic, or is it just kind of depending on the land space? How do you guys evaluate what the right opportunities are for those?
Yeah, there really isn't a common formula, and different investors are willing to do different things, right? Some just for whatever reason their buy box has no interest in attached product, and they only want to do detached, fee simple homes. Others are very focused on that horizontal regime that I mentioned. Others are more open and opportunistic, and will look at each asset class on its own merit, based on returns, based on location. Today it's all working. So, it more comes down to preference, because, it's an asset class that's functioning very well. Some of the limiting factors, of course, are zoning, requirements in municipalities and what the city will allow. So if it's already zoned and can't be rezoned, and it needs to be 10 to 12 units to the acre, then you're probably gonna have to do attached product. But it's really the land planning and entitlement side of things is kind of the limiting factor on what can and can't be done. But once that gets approved, there's opportunity for thousands of investors that like varied products. And as I said, with the demand for housing right now, and seemingly for years to come, there's not going to be any shortage of interest, no matter what the product is, from what we're seeing.
Yeah, that makes sense. From what we're seeing too, a lot of these investors kind of stick to what they know, right? So if they've migrated from multifamily experience, going into a more attached type of community style might be more inclined with their type of experience. The other thing is that we'll evaluate this as we go through some of these portfolios, but there's obviously pros and cons with each of these types of layouts and structures, and whether they're scattered or communities, and if they're detached and detached. So without further ado, why don't we jump into our first portfolio? I believe the first one is the larger Phoenix build for rent portfolio.
Yes, sir. And let me find that. I just hit screen share. Give me 1 second. All right. So yeah, here we've got a 96 home build for rent townhome project. And this is actually two separate subdivisions here in South Phoenix off of Central and Dobbins. Essentially, they're about a block or two apart from each other. One is a 58 townhome community. The other is a 38 townhome community. But it is a package deal, same developer, same builder. This is a really kind of a unique deal when we were talking about, the different versions of build for rent. This one is all attached product, pretty high density. This one comes with 2, 3, 4 bedroom townhome units, some with carports, some with 1 car and 2 car attached garages. The 4s have the 2 cars, the 3s have the 1, and the 2s have the carports. Very infill style type of community. It's about 5 miles from downtown Phoenix. Significant returns on stabilization. These homes are coming out of the ground now, and first units will be delivered in August, September of this year at certificate of occupancy, giving a buyer the opportunity to write a forward commitment, and then close in monthly tranches starting say this August on the first 8 units, and would be about 8 units delivered at certificate of occupancy each month after that, and allowing the buyer to work on their pre-leasing, moving the tenants in right after they close, and just walking themselves through the community as the builder is delivering units, which is a real advantageous strategy in build for rent, because as you're deploying capital, it's immediately working, as opposed to kind of the traditional multifamily buildings where you put up 200 units, they get CO'd nearly all at once, and now you've got 18 months to start leasing them up. These you can start leasing up right away. As you can see, once fully leased and stabilized, the projected return is about a 5.79 cap. That's arguably gone up since we started marketing this, just because the rents in Phoenix here are continuing to climb. This has really been a great opportunity for investors, and Sean, you had mentioned it. It's an ideal investment for the multifamily guys that are looking to get in to the build for rent space, because it has such a similar look and feel to the multifamily asset class.
Absolutely. So I guess, one of the first questions is, when you're evaluating some of these things, I guess, Libby, we'll start with you maybe, in terms of the terms of the loans and whatnot. What are you looking for in terms of information for the investor to start thinking about getting a term sheet out and evaluating their yield factors and whatnot?
Yeah, and I think this, portfolio is a little different from the other couple in the package here, but just the time frame on this one, it's still in the middle of construction, so wouldn't be at that point to offer a term sheet for permanent financing. Typically, we'll see them enter underwriting around 80% occupancy, and then we'll consider it fully stabilized at 90% in order to close. And we'll allow for lease up period during underwriting, and we've been able to get through underwriting within 30 or 45 days, so they lease up fairly quickly. Just the concentration of this portfolio in particular, it would be very simple from a valuation standpoint to get this done at a cost-effective, rate, to be able to do this all under one and then allocate values based out on each parcel. So I think it's a great portfolio, and as it gets closer towards completion, it would be certainly contender to enter underwriting at CoreVest.
That makes sense. Yeah. You mentioned concentration. I know from a risk management perspective, from an insurance view, concentration of risk is something that we're actively, evaluating when opportunities come through our door. And, South Miami, type of concentration of risk is much different than prime risk like Phoenix. Lee, from a risk management standpoint, what are some of the things that you guys would help consult with your clients to evaluate?
Yeah, thanks, Sean, and everyone. So in this particular portfolio, a few things come to mind. Number one is, how are how are the units being conveyed? Is the whole parcel being conveyed? Is there an HOA that's been formed or a townhome association that's been formed? And what is the townhome association responsible for insuring? Are they responsible for insuring the amenities, right? Because you see there's swimming pool, there's other amenities. Are they responsible for insuring the exterior of the buildings or the exterior and interior of the buildings? Or if these are fee simple townhomes, then you as the investor that's building for rent or buying these properties, we would look at more of a traditional policy that's going to cover the exterior and the interior of the units. Most of the time in a townhome association, each individual unit owner is responsible for insuring that property. But again, as we've alluded to a few times, this is a bit of a hybrid between an apartment and the scattered site single family that we see. So some insurance companies don't love the concentration of risk. In Phoenix, you don't have as many natural disasters, like as you mentioned in, say, Miami or other parts of the country that can come through. We're seeing a lot of this, and I don't want to get off the subject. We see a lot in Texas. So a lot of the times in different parts of the country where you have these types of hazards, this concentration of risks can sometimes not actually help you from an insurance perspective, or you need to make sure your insurance is structured so that if you have one large peril that comes through, that you're properly protected and you're not going to be too exposed. There's a ton of just different things as well here. From the perspective of, are you acting as the developer or the builder? I think this portfolio, this would be a buyer coming in, buying it from the existing developer. We're seeing a lot of vertically integrated investment groups right now, though, that are buying raw pieces of land and developing them. So we encourage our clients to think about the exit strategy. Are you going to form an HOA? Are you going to convey those amenities to the HOA? If not, we've got to make sure that we've got insurance in place. And again, you want to make sure that those amenities that you're using to attract your residents are maybe cordoned off or sectioned off so that you're not putting these asset holding entities at risk. So we try to define what's an operational entity versus an asset holding entity, and clearly define some differences there so that we can properly protect each of those entities.
And Sean, if you don't mind me jumping in real quick, because I probably left out a couple of things that would have helped both Libby and Lee comment a bit further. But Lee, to your questions, the developer is not going, and builder is not going to activate the HOA, even though they're underlying CC&Rs, because the buyer is going to be buying the whole community and professionally managing it from there. These are all fee simple parceled townhomes. So as an owner, you own the air above and the land below. So it's not a horizontal regime. And Libby, with the forward commitment that the buyer has the opportunity to do, I guess my question to you, and we can circle back to Lee just so we can discuss how he would look at the insurance side of that, based on not having an HOA and just being professionally managed as a whole community. But would there be any bridge lending options on the tranche takedowns through CoreVest as well, prior to rolling it into a more permanent financing once stabilized?
Certainly, yeah, we've definitely seen it come full circle where it starts out on the bridge or construction through the second tranche or what it might be, and then it rolls over to term, and it's a seamless process just to stay with one lender. So we've certainly seen it all across the board, and it's a great avenue.
Yeah, in terms of, Lee, did you want to comment?
Well, I was just going to say again, kind of to your point, Michael, the big concern you're going to have though is you've got these fee simple, right? I would assume they're individually platted. The parcel is platted, but you're going to have this parcel where the pool and any other amenities are going to be. So you want to make sure you've got that insured. And we would recommend that you really try to take that out of the same entity that you may own the rest of the hard assets of the dwellings in, because you don't want to have, and a lot of times a way to solve that is the HOA. You convey those to the HOA, and the HOA can insure those pretty affordably. But if you don't do that, you really got to think about those amenities and making sure where are they insured, where's the deep pocket in the event that there is some sort of claim, bodily injury or property damage claim, and then how do you insulate that claim from the actual asset holding entity that owns the 96, homes here. So you
Sure.
don't want to expose the 96 homes because of the pool. You just got to make sure you've addressed it. And again, that's something you've got to be very just aware of. What's that strategy?
Yeah, good point. Thank you.
So Randall, in terms of, the lead time on this is something that's August, September. When would you suggest the investor reach out to somebody like yourself at PMI to get some input on what the property management practice would look like and some of the cost components to that?
Yeah, it's a great question because as Michael illustrated earlier, the industry has certainly changed a bit. We have these new asset classes and we have a lot more pressure on a property management company to perform differently. So whereas in the past, you may, like if this were a multifamily site, it would be much easier to go and partner with one of the bigger companies and you'd get amenities and you'd get a multifamily experience. Bringing that type of experience to a tenant is important, and it's not in the current capability of many property managers who are looking at kind of adjusting to the new market. So whereas in the past, you may think of property management as just kind of an afterthought. Hey, we're going to get involved here. We know we just need to find a manager who's going to be able to service the builder, act as the go-between. In today's world, I think you want to find a manager like PMI who's going to get involved as early as possible in the process to help get the correct rents, help understand and evaluate what is the correct management fee, what is leasing cost, what is renewal costs, all of these issues that are coming up on a property type like this that are different than a multifamily or true multifamily or a true scattered site. So like when I put this out to bid to our guys in Phoenix, they came back with, hey, somewhere between 3 to 5% on rents. They want to take a look at current market and see where they would project getting that and what the lease up would take. They're offering to help manage the HOA as well and facilitate that, which is unique to PMI. But I think the point is the pressure in the industry has caused managers to elevate the value that they're adding to the investor. And so with that, I would say get them involved, a true a property manager who's going to add value as early as possible, even during the lending, the title work, all of that stuff. Have that manager's eyes on that, helping to consult with you.
No, it's really interesting. So it's more of a consultative approach rather than just sign up if it's ready to go.
Yeah, I agree, especially because we're talking about amenities now, amenities that are typically reserved for like a multifamily type of site, and you need to build and elevate that tenant experience to create long-lasting relationships and tenants that'll stay longer. As Michael mentioned, this opportunity it fills a market need with the rising house cost and house prices. So you have to find sort of that manager that is going to create a better tenant experience. And what I mean by that is not just managing the amenities well, but also creating unique value-added services for that tenant, which is a new thing, and offering that to scattered site as opposed to multifamily. Multifamily figured that out years ago, but now it is making its way into scattered site and opportunities like this where multifamily typical manager won't touch this. So that's kind of the unique aspect.
Yeah, I appreciate you mentioning that. And we've talked about multifamily a couple of times on this call already. One of the questions that came from the audience, which I think is timely, is why is this not considered multifamily? What's the delineation between what this would be versus multifamily?
I think just from.
Oh, go ahead, Libby.
I was just going to say from the fact that they're individually parceled out, it breaks it up. When we're considered townhomes, they could be sold off individually, potentially one day. So that's like how we would differentiate this from the multifamily and underwrite it in that way.
Okay. And I'm sure, Peggy, from a title perspective, maybe is that similar?
Yeah, from a title perspective, they definitely are not multifamily.
Okay.
They're single deed per individual unit. A couple of things just to add into when title would actually get involved.
Yes.
We'd want to be involved with the opportunity with the developer to possibly engage on any construction draw needs that he may have. We would also want to get the schedule of each tranche, each unit, so that everything is prepared to go once the COs come in. so that we have everything in advance versus, okay, the CO's here, now we're going to take another 2 weeks. Everybody's waiting to get into their units, so we want to make sure we're ready.
Everything's usually buttoned up though, isn't it?
It should be. That's why I always offer to be part of that solution before CO, so that we can make sure it does happen.
What are some of the?
That's an imperative aspect of this when you're delivering it in tranches at CO, because title's got to be aligned, the builder's got to be aligned, property management has to be aligned because they're typically pre-leasing these homes. So you've got tenants that are hopefully somewhat flexible, but it's real estate. So if they're planning on moving in, next weekend and, title wasn't working on it until it was CO'd, well, now they're going to be out 2 more weeks per Peggy's comment. So there's a lot of coordination that has to happen when you're delivering in these tranches.
That makes sense. You want to, anything else you guys want to go through on this, or do you want to move on to the next portfolio?
We can move on if nobody else has any comments.
Okay.
While you guys get that up, I'll just kind of fill the void here, because, looking at these properties, you do have to look at them each individually, as a standalone portfolio. All of these pieces need to be considered. So, we've thrown them into these buckets of build for rent and SFR scattered site. The reality is that, as you can tell, there's a lot of complexities involved on each of these properties. So it's really important, I think, to get a team of people looking at it early. And as Michael was mentioning on the, not just the property management side, but the title, the lending, the insurance, all of these pieces, which is why this mastermind is so great, because as you'll see on this next property, it's going to be a completely different look, at least from my perspective and probably from some others on here. So it's really interesting to kind of get that mastermind involved.
Absolutely.
Good point. And sorry about that, everybody, for the little tech difficulties here. But here's our second portfolio that we're talking about today, which is really a combination of the scattered home portfolio and build for rent product. These were 42 homes that were built in late 2020 and the rest throughout 2021 in 3 different subdivisions and 3 different MSAs in Texas. So we've got 20 homes that were built in Northeast Austin. We've got 15 homes that were built in West Houston, and then 7 homes in San Antonio. The Austin and Houston homes were all built by a public home builder. So they were building a full retail community for sale homes. But this investor purchased a small portion of homes from each community, and then the San Antonio 7 homes were built by a regional builder there, again building out a for sale community where the investor came to the table and bought a small portion of the homes. They leased these homes up shortly after acquiring them, and we're operating anywhere from about 10, 11 months all the way down to 2 or 3 months by the time we actually took this deal to market. We had kind of a whisper price of $16 million. It's a strong price, but there's been a lot of activity in the market. So we wanted to push it probably maybe a little bit more than we should have, but the market always speaks. And this is a great opportunity to acquire fully leased new construction homes with significant value add upside. These homes were leased while the rest of the community was still being built out. So a little bit of construction going on, couldn't hit those high market rents. But now that the turns are happening or renewals are happening, they're getting $200, $250 rent bumps on all the homes because all the communities have been finished. And realistically, this is going to be a stabilized cap rate over 4% with the types of rent bumps that have been occurring. Even though it says stabilized 3.31 there, it's a little dated from what we're now seeing happen in this portfolio as units have been turning in the last 2 months. But great opportunity to look at a new construction scattered home build for rent portfolio.
Thanks, Michael. Peggy, I'll start with you this time. In terms of title, on the last one, right, it's a construction's happening. These ones are already completed. What are some of the things from a title perspective that an investor should be looking at, and what issues might they run into here?
Actually, the due diligence period, we always want to get title out as quickly as possible. The tools that our group provides is a single view, so that you can quickly see if there is a group of properties that maybe title, there are some characteristics that need to be corrected, or a general focus. We call those out immediately, so that the investor can see that, one, it's either a really a slight issue, it'll be resolved right away. It also allows the seller to quickly focus on anything that needs to be corrected. One of the bigger things that we always look for, and I'm actually familiar with this inventory. The one thing I always look for is the seller really entitled, especially if they've owned it for a year or so. If it's a short term, we always want to make sure that title was transferred properly.
That makes sense. And Randall, I guess this is a little different in that there's multiple MSAs even in the same state. San Antonio is a bit of a trek from Houston. So how might that differ from a property management strategy?
Yeah, it'll differ immensely. Typically the same players that would touch the last property that we looked at are not quite the same as are going to be looking at this. And so at PMI, we've kind of adjusted that to be able to have like a multi-site approach so that we could take this portfolio and handle it. But you would expect management fees to be higher on a scatter site. You would expect your maintenance fees to be higher. And a good property manager will kind of help you think through those. But when I put this out to bid for our guys in San Antonio, I got right around 7 to 8% as far as the management. But that could be negotiated down if you were to group those 20 together. Again, single site versus scattered site in property management, much more difficult to manage. But you want to find a manager who is familiar with these types of properties and is able to service this type of portfolio. One other interesting consideration that I'll bring up that may surprise many of you guys out there and maybe even on this call. One trend that we are seeing is that many of these types of portfolios, owners and investors are considering different use types for these properties. So for example, one trend that we're seeing right now is on a short-term rental as an option, or a furnished style rental. And we have tools and analyses where we're looking at that. We've entered that space from a management perspective and converted many of our 30,000 residential doors over into those short-term type of opportunities to capitalize on that market as well. So you definitely want to find a manager who is able to kind of look at that, handle that, and help analyze the highest and best use to take an appraisal term and use that in a property management setting. So kind of an interesting thing.
So being that you guys are national, how would you, as a property owner, if you will, or an investor, look at the differences between, should I go for one property manager or break it out individually? Yeah,
the big thing is the tech and tools that are not common. Like you can see in a portfolio like this, if it's scattered site, there might be 3 different reports that are generated by different property managers using different software. And so the benefit of finding someone who can service this entire portfolio is to unify your reporting, to unify your banking, to kind of get a good operational slick system put together so that it runs well. So that would be the big difference, Sean.
I think that's an interesting point too, because at some point an operator may decide to sell, and having all the reporting done by the same property management company and all very concise, as opposed to, maybe having 3 different property management companies here because they're in 3 different MSAs, it can make it a lot more challenging on the buyers who are trying to, kind of funnel all the information down into a concise look so they can make a good business decision.
Agreed.
Absolutely. SES, we represent several of the largest leading insurers and have underwriting authority on their behalf, but each of our carriers have different appetites. So I guess, Lee, in terms of an insurance perspective, how do you evaluate how to find the right home for some of these folks?
Yeah, well, to kind of expand on something that Randall said as well, Randall, you mentioned about some of the properties being furnished or short-term rentals, which the insurance industry is not in love with the short-term rental model yet. I know, it's going to be a great segue for Libby because CoreVest just came out with a short-term rental product. So we're still trying to get our arms around what, when you mix and match the short-term rental into that. And thankfully, we've got great partners at a retail level working with providers like Sean and his company to come up with solutions for those types of situations. But when we look from an insurance perspective on this, if you're going to have a furnished house, we're going to make sure you've got those furnishings, insured. It's just a little bit of a different model. But what we like about this portfolio, though, is that there is that spread of risk, right? Whereas in Phoenix, you have very concentrated risk. Here, you've got 3 different MSAs. And Houston's going to be the toughest out of all of those MSAs from an insurance perspective. And as far as insurance pricing, it's going to be a little bit more. It's closer to the coast. One thing I would recommend as well is that as a buyer, you check flood zones, not just for this portfolio, but take a look at the flood zones, right? Make sure, and this doesn't really have a ton to do with insurance, but make sure that if your strategy does change, that you're not violating any of the rules of the HOA if there is an HOA in place for some of these. And your property management company would do that, and the work that Title does to provide, the CC&Rs of all these as well. I'm sure you could check that easy as well. One of the things that the insurance industry is going to look at as well too is the space between homes, right? Michael, you alluded to this earlier. The closer they are, sometimes some insurance companies are not going to want to have homes that are too close. You have a fire that jumps from house to house to house. So sometimes there's just those types of things to consider. But what we like here is that spread of risk, and again, you've got a little less concentration.
Absolutely. Well, I appreciate you mentioning the short-term rental program. Libby, if you want to jump into that, it sounds like great.
Yeah, no, I'll jump into this portfolio a little bit here. I think, different from the prior portfolio where you're in that concentrated area, we'll typically see, the tenant turnover be, much less in this type of setting. So the underwrite, changes a little bit where you see, some folks stay closer to 5 years in a product like this. So the underwrite is slightly different, but, given that they're still all parceled out, we'll kind of look at it in the same area. And like Randall had mentioned with the property management, it's great having just one PM be able to go through the different MSAs and get through the diligence process, providing rent rolls, getting through valuations, everything is incredibly helpful. But on, the short-term rental side, it also fits into that bucket, and that these specific product is very homogeneous. That's what we like to see. It's not, your large bachelorette type party house where you have short-term renters that are going to be there for maybe 8-9 days, and the turnover is a little less. So it's certainly a product that we like to see in the short-term rental space.
Yeah, absolutely. Plus the vacancy, opens the door to other risk from an insurance perspective as well. So, hey, Michael, I know we have one more important portfolio to go through. So maybe we can jump to that and then spend some time going through a more of a roundtable.
You got it. This is a very unique deal. Obviously quite a large sticker price on there. So I do want to mention to any investors that are on the line, and I just had this conversation with the seller yesterday, we're going to start opening up the opportunity to do this in smaller chunks, maybe, 10, 15, 20 million, more bite-sized deals to open it up to more investors. But we've got 355 homes here in Imperial County. For those of you that are unfamiliar with Imperial County, California, it's Southern California, east of San Diego County, just north of Mexicali. It's really become a commercial and retail and industrial hub for Southern California. Huge job base there with Department of Corrections, DEA, renewable energies, and it's one of the biggest agricultural areas for all of California. There's been about 25% population growth over the last 10 years here, and this builder literally cannot build homes fast enough. He's been building this portfolio out since about 2010. It's an interesting story. He sold his home building company pre-recession to Pulte, and then the recession hit. He bought all of his land and lots back in 2010, and started building homes here as the population was continuing to grow. He's basically had every home pre-leased prior to CO here, and he's building about another 300 homes that he's planning on renting in the area to keep up with the demand. It's a very unique portfolio for either those investors that have huge capital to spend, and now we're going to be remarketing this a bit for smaller investors and groups that may have smaller 1031 needs. But it's really nearly all brand new homes or close to in the last 5, 6, 7 years, and great family community. And for the California investors, it's a a 4 cap may seem low to Midwest investors, but 4 cap looks pretty good if you're investing in LA, Seattle, San Francisco. So we're excited about this one. We just hit the market not too long ago, and we're going to start giving it some different looks to open it up to different investors with different capital needs.
Thanks, Michael. And just real quick on the size of this, I guess, Libby, to start with, is there anything that's too small or too large for you guys to handle?
Typically, we were around like 50 million on the term financing, but we consider something of this size for sure.
Okay, sounds good. And then Randall, is there a value play in having 1520 versus 300, and when does it make sense to kind of break that out a little bit more?
Yeah, there's definitely some break points involved on the management side. So when I put this out to our SoCal guys, I got kind of around that 5 to 6% quote on management fee, which is a little lower than we might typically see. And that's that break point that you're talking about, Sean, is that because on this type of portfolio, you're going to have a dedicated team. It's probably going to be a team of 3, at least at PMI, it would be of that size for a portfolio of this size. But you do get some scaling, breaks and some just capability when you're using similar maintenance and you're using the software breaks that happen as the portfolio scales. If you're looking at the numbers, you should expect to see kind of that break point at around maybe 50, and then at around 200, you'd see another break point. And it depends on the market, but maybe you see a percentage drop at each kind of break point at the 50, and then again at the 200 from a management fee. But make sure that you're talking about the other details involved in this type of management opportunity, meaning what is lease up going to be? Because you'd see a break over 100 on that as well. And so that can be a big cost that hits investors unexpectedly if they're not used to it. And so, yeah, absolutely. There's some unique aspects of this portfolio, but yeah, we would love to manage this.
That sounds, yeah, breakpoints are interesting at those scale levels. Lee, from an insurance perspective, do you see where a portfolio is too large or it might shift the structure of the insurance program?
Yeah, and when you have more scale in a state like California, it can definitely help. Again, this portfolio, you have some spread of risk, and we would look at probably structuring this policy a little bit differently than an investor with 20 properties. We'd probably look at, if you've got $110 million of property value, we probably would look at a master policy that's going to have some coverage, some limits. Maybe you don't need, because you've got scattered site residential, you don't need $110 million. Maybe you can model the portfolio. The insurance industry and the lending industry a lot of times will accept a risk model through a company called RMS, which is widely accepted. And so your probable maximum loss may only be $10 million for any one peril. And so you can insure for $10 million. That way you can drive your rates down. You're going to make sure you've got proper liability coverage though when you have this much in assets. So you're going to want to make sure you have excess liability. If you're going to borrow money from somebody like CoreVest, more than likely they're going to require that you have excess liability in place in the event that you do have a claim that exceeds your primary liability. So there's a few more insurance considerations you'd want to have on something this large. But the spread of risk here is definitely something that would be attractive. And also California in general, one of the bigger perils is going to be wildfire. I'm not sure in Imperial County what the wildfire exposure is. So you want to make sure there that you don't run into any issues. And then of course, earthquake. You do have quake exposure in California, and that is going to add some extra expense if you do have to or want to insure for earthquake.
Makes sense. Peggy, I guess just in terms of title, is there any particular county or state that's more challenging than others, or are they all pretty similar?
I think at a national level, it's you just have to figure out whether it's a municipality that's available online, or whether that's going to be a challenge, whether you have a walk-up situation that would not be a challenge as far as getting the work done. It would just be the timelines to hit. One comment I did want to make on this portfolio is, if you're going to offer it in different groupings, Michael, I think there's like 7, it looks like 7 vesting entities here, and it doesn't appear that they're driven by community only. They're in different groups, so you may want to consider that. Otherwise, you'll have to create an entity to sell out, most likely.
Makes sense. Libby, from an interest, or I guess from a rent perspective, with all these rents jumping up, Michael was mentioning in Phoenix, rents are continuing to climb. It's pretty much nationwide. I think last month marked like the 20th consecutive month of rate increases, 15, 20% or something like that over year. How does that factor into how you guys are projecting yield factors and qualifications for loan to value and all that?
When we're taking a look at the loans, initially we'll, require the rent roll and the actual leases to come through. But, looking at the portfolio on an ongoing basis, taking into consideration these rent increases, it's always a factor when it goes to servicing. But I think, in this market where we've seen the home price appreciation, in skyrocket, the rents, are traveling at the same rate, but they're not 100% there. So we have been seeing, the yields come through in a little more condensed fashion. But, it's something that we're taking into consideration, and it's we'll go back and go through the appraisals, make sure that the rent comps are lining up along with the sales comps in the appraisal report. So it's a little bit of both, but it's certainly a little tougher right now with just where the yields are at, and especially in a market like this in California, it might be a little tighter.
Yeah, you got to be a little conservative because it's probably not sustainable to continue to raise at that same level.
Yeah.
Makes sense.
Well, just one thing real quick. I'm sorry, kind of along those lines, what we've seen, and this is a little bit over the last several years, as home price appreciation has occurred. In the past, we would always have discussions with investors about the replacement costs of properties and what the true cost to replace was. And in the past, where you didn't have the home values that you do now, the insurance industry would also often be insuring in excess of what the market value is. We've seen a bit of a flip there, where we've seen home prices appreciate so fast, replacement costs sometimes can be less than the appraised value, or less than even the loan to value that's maybe the allocated loan amount for a property. And so it's a little bit of a different conversation that we have with the lenders, like, hey, we do have enough replacement cost here, even though their home price appreciation is outstripped or outpaced it. So those conversations have changed over the last several years, and it's happened very quickly.
Yeah, I appreciate you bringing that up. For our carriers, it's a top of mind topic, in that lumber prices and all the other construction costs are increasing rapidly. So these stated values of insurance, to replace the properties are changing underneath your feet. So something to definitely keep an eye on. Well, as you can tell, there's a lot to think about when evaluating these things, and partners that like the folks that are on the phone are extremely valuable to investors as you guys are vetting out different opportunities. I suggest that you guys reach out to those partners as early and often as possible to make sure that you guys are thinking through the right questions to evaluate the right factors on each of those opportunities. Michael, in terms of like breaking these opportunities up, like this larger one, it might be listed on the site as one way. How would they go about contacting you guys to explore what those, bifurcations might look like?
Yeah, it'd be as simple as just reaching out to me, or Tom Johnson, whose number is on the line on the page here, but you can easily find my contact information online. But we would share the entire property tape, which comes with all the necessary data, addresses. So there's locations in El Centro that you would prefer over another. The homes are scattered enough but still kind of clumped together enough where, sort of each batch is roughly, 10, 15-minute drive from the next batch. So it'd be pretty easy for a buyer to, to look at the portfolio and kind of determine, which homes they may or may not like. And maybe a buyer wants to focus on all homes built after 2018, or maybe they want a little bit of the older homes, or, so number of ways to look at it, but we can share all the necessary information to allow them to break the portfolio down to fit their needs.
Perfect. And this is only 3 portfolios out of dozens that are on the SFR Hub website. So I encourage you all to check those out and reach out with any interest. Appreciate everybody's time and interest in joining today's webinar. Hope you guys got something out of it, and look forward to seeing you around the industry.
Thank you, everybody.
Thank you very much.
Thanks, everyone.
Bye, everyone.